Hello, Super Saver. I hope you're having a good week. I'll be continuing our FDIC series this week to answer some of the most frequently asked questions you've had about FDIC insurance recently. Here are the top 5 FDIC questions I'll be answering today. 1. What does FDIC insurance cover? 2. What does FDIC insurance not cover, but SIPC or other protection schemes may? 3. How can you increase your FDIC coverage in certain instances? 4. How can you use the FDIC calculator to see if you're fully FDIC insured? And 5. What happens if your bank actually defaults? As many of you already know, FDIC insurance covers depositors' accounts at each insured bank, dollar for dollar, including principal and any accrued interest through the date of the insured bank's closing, up to the insurance limit. And the standard deposit insurance amount is $250,000 per depositor per insured bank for each account ownership category. Now, it seems that there are quite a few questions around this account ownership category element of FDIC insurance. So, I'll be covering that in greater detail later on in this video, as well as some possible ways you can use the different account ownership categories to increase your FDIC coverage within the same financial institution. But first, let's start with what FDIC insurance does cover. If we go to the Your Insured Deposits page on the FDIC's website, which I've linked below, and we scroll down, we can see that FDIC insurance covers all types of deposits received at an insured bank, but it does not cover investments, even if they were purchased at an insured bank. Here's the full list of what the FDIC covers. Everything from checking and savings accounts to certificates of deposits, CDs, cashier's checks, money orders, and other official items issued by a bank. Here's the list of investments and other items that the FDIC does not cover, even if they were purchased at the insured bank. So these securities here, stock investments, bond investments, mutual funds, municipal securities, and U.S. Treasury bills, bonds, and notes are not protected by the FDIC, even if bought at the failing bank. However, the same securities may be protected by the SIPC, the Securities Investor Protection Corporation, if they're held in a brokerage account at an SIPC member firm. Always make sure you understand which of your assets are held in a bank account versus a brokerage account, as this will determine whether the FDIC or the SIPC will be your applicable protection scheme. And always check your brokerage house to ensure that they are an SIPC member firm. The vast majority are, but it's still something to keep an eye out for. And the same goes for FDIC protection. Our focus today is on FDIC protection, but I did want to give a quick glimpse as a side note on SIPC protection as well. So, according to the SIPC website, they protect against the loss of cash and securities, such as stocks and bonds, held by a customer at a financially troubled SIPC member brokerage firm. The limit of SIPC protection is $500,000, which includes a $250,000 limit for cash. It's important to understand that SIPC protection is also limited in the sense that it only replaces the missing securities and cash that's in your brokerage account when your brokerage firm shuts down. SIPC protection does not protect against market fluctuations in security prices, meaning that you can't claim SIPC protection if you buy a certain stock that suddenly drops in value. So no, the SIPC will not make you whole if your favorite tech stock suddenly drops in price or even goes out of business. So here's a useful summary of what the FDIC does and does not cover. There are really 4 main buckets that we should be aware of. 1. Deposit products at your bank, including certificates of deposits, CDs, are generally covered by the FDIC up to their limits. 2. Security investments, even if bought at your bank, are not covered by the FDIC. However, They may be covered by the SIPC up to their limits if they're held in a brokerage account with an SIPC member institution. Always make sure you understand where your investments are booked. 3. Insurance products are not covered by the FDIC and are covered only in a very limited way by the SIPC if held via a brokerage firm. SIPC protection is not available for life insurance or fixed annuities and is limited with respect to claims for variable annuity contracts. However, as these are insurance products and depending on the circumstances, some of them may be covered at least in part by an insurance protection scheme such as the Guarantee Fund Protection Scheme in New York State. I won't delve into insurance protection schemes in this video though. That's another topic for another time. But do drop a comment below if this is something you're interested in learning more about. So finally, 4. Safety deposit boxes, the contents in them, as well as crypto assets, as some found out the hard way with the FTX collapse. These are not covered by the FDIC, SIPC, or other insurance protection schemes, regardless of whether they are held in a bank or brokerage account. So if you keep cash or any high valued items in your safety deposit box, think twice. Now that we know what the FDIC covers and what it doesn't cover, let's talk a bit about the different account ownership categories and some ways you can increase your FDIC coverage in certain instances. The simplest way to increase your FDIC coverage beyond the $250,000 limit is to open additional accounts with other banks. The FDIC limit applies per account ownership category per insured bank. So if you open savings accounts in your own name at 10 different banks, yes, that means that you'd have access to the full $250,000 FDIC protection limit times 10 for a total FDIC insured value of up to $2.5 million. But say that you're a financial minimalist. You want to keep your finances simple and have all your savings in one bank. There are a few different ways to increase your FDIC insurance limit, even in this instance. Let's start by taking a look at the FDIC's Are My Deposit Accounts Insured by the FDIC page. If we scroll down, we can see all the different account ownership categories. Remember that the standard deposit insurance amount is $250,000 per depositor per insured bank for each account ownership category. So if my husband Marcus and I have a joint account, this ownership category here, we're each covered for $250,000 for a total of $500,000 on this joint account. To get more details on what qualifies as a joint account, we can click on this arrow here. This also means that if Marcus, his sister, and I owned a joint account together, I know, weird, but it's just an example. If all three of us shared a joint account, that joint account would be FDIC insured for up to $750,000. That's $250,000 of FDIC coverage times 3 for the three of us whose names are on the joint account. But say that I don't like Marcus's sister and I don't want to own a joint bank account with her. It's actually okay. He doesn't have a sister. So I haven't hurt anybody's feelings here. Anyway, another way Marcus and I could increase our FDIC coverage at the same institution is if each of us opens a separate single account at the same financial institution. Because as we can see here, a single account and a joint account are considered two different account ownership categories and are counted separately for the FDIC insurance limit. Meaning that the joint account that Marcus and I share would have up to $500,000 of FDIC coverage. The single account that belongs to me would have up to $250,000 of FDIC coverage, and Marcus's own single account would also have up to $250,000 of FDIC coverage, for a total across the three accounts we own of up to $1 million of FDIC coverage. But let's say that I'm still 25 and single. Feels like only 2 years ago, honestly. What are my options then for increasing my FDIC insurance at the same institution, if I don't want to spread my money across several banks? Well, I could add beneficiaries, what's known as POD, or payable upon death. This is best practice in any case to avoid probate upon death of the account holder. If we go back to this account ownership categories list, PODs fall into the same category as a revocable trust account, as we can see here. A deposit account owned by one or more people that identifies one or more beneficiaries who will receive deposits upon the death of the owner or owners. This includes both formal living trusts and informal in trust for ITF or payable upon death accounts. All revocable trust accounts owned by the same person at the same bank are added together, and the owner is insured up to $250,000 per beneficiary. Those are just a few of the different ways you can increase your FDIC coverage if you want to keep all your money with the same financial institution. Now, if you're interested in calculating whether your hard-earned savings are fully FDIC insured at your bank, the FDIC actually offers a useful, relatively straightforward calculator for doing this. So here's what the FDIC calculator looks like. I've linked this in the description below as well for those of you who want to play around with it. Here we can enter the bank name. The bank lookup is optional, so I'll just put in my bank. Then I'll scroll down and select personal account. And for the ownership type, I'll select POD ITF with beneficiaries because I want to add our kids on as beneficiaries. And if I want more information, I can click on what's this right here. And this box will appear explaining what POD ITF means, which I explained in the earlier section already. Under owner, I'll add my name and select yes because, well, thank goodness I'm still living. And then click on add additional owner because this is a joint account with Marcus. Then I'll scroll down further and add Marcus as the joint owner. Thank goodness he's also still living. Then I'll start adding my first child as the beneficiary here. And I'll choose the beneficiary type, which in this case is person. And once again, I'll select yes here. And I'll click on add additional beneficiary to add our 3 other children. And when I'm done, I'll name the account here. And for the balance, I'm going to put in $2.5 million. We don't hold that much in cash right now, but this is just to show you one more example of how much FDIC coverage we can add to our joint account with our 4 children as beneficiaries. And then I'll select add to report. And this is what shows up on screen. Here's the joint account I just added with the make-believe $2.5 million balance. Marcus and I as joint owners and our 4 children as beneficiaries. As you can see from the balance, because this is a joint account, the $2.5 million balance is split 50-50 between me and Marcus. Now, I'll click on Calculate Coverage. And here I can see that I'm FDIC insured for up to $1 million because there are 4 beneficiaries on this account. That's $250,000 of coverage times my 4 beneficiaries. Marcus is also FDIC insured for up to $1 million because there are 4 beneficiaries on this account. But this red section here means that we're each underinsured by $250,000 for a total of $500,000 that's not insured by the FDIC. In the event that this bank ever fails, this total amount here in red that's not FDIC insured could potentially be lost or used in a bank bail-in. If you don't know what a bail-in is, I've linked a recent bail-in video in the description below. Right, so the great thing about this calculator is that it shows me where my weak spot is, where I might not be covered. If the calculator example I just walked through was a real-life example, Marcus and I would now have 3 options if we wanted to make sure the uninsured excess amount is FDIC covered as well. 1, we could each set up additional single accounts with the same bank. 2, we could set up a joint account at another bank. Or 3, We could have another baby and add kid number 5 on as a beneficiary to this account here. Option 1 or 2 would probably be the easiest and least expensive. But hey, this is just for illustration purposes. Now, let's talk about what happens if a bank actually goes into default. The FDIC has 2 primary responsibilities when a bank actually defaults. The first is to serve as the insurer of the failed bank's deposits. The second is to serve as the receiver of the failed bank. So, about the first responsibility of the FDIC to serve as the insurer of the failed bank's deposits. This means that the FDIC pays insurance to you and other depositors for your lost deposits up to the $250,000 insurance limit per account and per ownership category. You either get a check or a new account at another FDIC-insured bank in an amount equal to the insured balance of your account or accounts at the failed bank. Where this has happened in the past, and yes, the US is a big country, and we have some smaller bank failures practically every year, the FDIC has usually proven itself very efficient and has typically paid depositors within a few days after the failed bank shut down. However, some cases can take longer. For example, if you have deposits established by a third-party broker or deposits that are more than $250,000 that are tied to trust documents. In fact, quite a few of our super savers recently shared their positive experiences with the FDIC when we posted this video on the leaked FDIC video that was actually not leaked at all. From one super saver, as the customer of a failed bank in 2007, the experience was seamless. The regulators shut it down on a Friday, and on Monday, the website was up and running as part of ING Direct, the bank that acquired the failed net bank. And from a second super saver, I had a CD in 2008 at Chorus Bank. They went belly up. I got a check for the amount that I was due in just days. And last but not least, from a third super saver, I think I've only seen one bank shut down back in 2008. The Feds shut it down at 5 p.m. on Friday, the regular closing time. The next morning, the ATM outside was open, and the bank opened at 9 a.m. Monday morning. I think you get the point, my financial friend. The FDIC seems to try its best to return depositors' funds at a failed financial institution up to the insurance threshold as quickly as possible. Now, let's move on to the FDIC's second primary responsibility, which is to serve as the receiver of the failed bank. In this capacity, the FDIC sells and or collects the assets of the failed financial institution and settles its debts, including claims for deposits in excess of the FDIC's insurance limit. If your deposits at the failed bank exceed the FDIC's $250,000 insurance limit, it is still possible for you to be made whole if the FDIC is able to successfully sell enough of the failed bank's assets. This would, of course, take some more time. Years in some cases, according to the FDIC. If, however, the FDIC as the receiver cannot raise enough cash from the failed bank's assets, your deposits that are in excess of the $250,000 FDIC insurance limit would be at risk of either being lost entirely or partially in the bankruptcy, or your excess deposits may be subject to a not-so-voluntary bail-in at the failed institution. In a nutshell, a bail-in means that you swap your deposits for a slice of the equity of the restructured financial institution. Check out this video here to learn more about bank bail-ins and how your non-FDIC insured funds factor into a bail-in if your bank were to ever go out of business. The easiest way to avoid a bank bail-in is to make sure that your deposits are fully FDIC insured. I've also linked the FDIC's FAQs page below for those of you who want more details on the FDIC's roles as both insurer and receiver when a bank fails. All right, Super Saver, I hope this video has helped you better understand FDIC protection and how to ensure that your hard-earned savings are fully FDIC protected, as well as address some of your top FDIC concerns. As always, if you enjoyed this video and learned something new, don't forget to share it with those you care about, and of course, hit that thumbs up, and see you again very soon with another brand new wealth building video.